This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Welcome to the AJ Bell Money and Markets podcast. I'm Danni Hewson, and we've got a packed episode for you today covering everything from the latest market news to changes in energy prices. Joining me today is Laura Suter. Hi, Laura.
Hi there. Yes, for markets this week, we're going to be delving into Apple's investment plans and also looking at why BP has rolled back its green investment plans. We've also got Shares editor Tom Sieber on to dive into some of the investment ideas from the world of investment trusts.
Also this week, Laura's going to be talking about the latest rise in Ofgem's energy price cap and shedding some light on the sneaky cash savings traps that could leave you with higher tax bills. Also, Dan Coatsworth is sitting down with Abbie Glennie, head of smaller companies at abrdn, for a chat about why the UK stock market is showing new signs of life.
But first, as ever, Danny, let's dive into what's been happening in the markets in the past week. So this week, we've had the news that Apple is making a major new investment. Tell us all about it.
Yeah, I mean, it's a lot of money as well, $500 billion. And you won't be surprised when I say that it is all down to Donald Trump and his tariffs, or at least Apple trying to figure out a way to sort of bypass some of those tariffs, because we know it assembles a huge amount of its products in China. And Donald Trump has hit China with 10% tariffs. And Apple is wanting to try and negotiate some kind of exemptions. Now, it did this back in 2018. Funnily enough, in 2018, that was also when Apple announced a £350 billion investment plan. So following a very similar playbook, it will guarantee 20,000 new jobs. It's all about new AI software development, a big factory in Texas. But despite the fact that Donald Trump, of course, being Donald Trump, has said it couldn't have happened without me on Truth Social, we don't actually know how much of that investment had been planned ahead of time. It is quite difficult, really, to sort of figure out what was in the pipeline and what is brand new. But it's clear it is a big amount of money. Now, we know that lots and lots of US companies are having conversations with the new administration at the moment. They want to get in Donald Trump's good books. We've heard a lot about the rolling back of DEI schemes, diversity inclusion schemes. And certainly, although Apple had initially taken a stance on that, it does seem to have sort of taken a step back from that now as well. So Tim Cook definitely trying to play the game the way that he has played it before and won. But whether or not we see changes this time to those tariffs that Apple will be impacted by because of the importing from China, we're just going to have to wait and see. But of course, markets have been really jittery this week because we are now on the 26th of February as we record this, and we're coming very close to the deadline when we find out whether or not those tariffs with China and Canada and Mexico, will actually come in. So there's all sorts of concerns behind the scenes about what might happen next. So a lot of US companies are really trying to sort of get ahead of that in order to keep their investors and shareholders happy. But what was very interesting actually is that Apple shares actually fell a bit upon this news. So clearly investors aren't completely convinced that this game playing will result in getting Donald Trump's ear.
And while we are talking about Donald Trump, a Money and Markets podcast would not be complete without mention of Elon Musk, which it seems crops up in the news every week. But Tesla shares are under pressure. So why is that?
Yes, I've heard him referred to as the first bro, which I think is really really good title for him. Look, we know that he and Donald Trump seem to be joined at the hip at the moment. There have been pictures of him in the Oval Office with his kids. This is Elon Musk. And he has been putting out on X quite a bit about cutting back the federal landscape. So the number of employees, asking employees to justify what they did over the last week. But you're right, Tesla shares absolutely came under pressure today following the news that January sales in Europe had been sliced in half. We're talking about a 50% fall in the number of electric vehicles that the EU had purchased compared to the same January last year. And you won't be surprised that Tesla shares fell. And it was the first time, actually, since November that Tesla's market cap had fallen below that $1 trillion mark. So, there were some sizable movements. Now, there's a lot of questions about why this has happened. Is it just that there is increased competition from Chinese markets? Is it that Europeans are buying less electric cars? Well, I can tell you that actually Tesla bucked the trend because electric car sales in the EU grew by more than a third over the month. So it suggests, and there has been a lot of debate about this, it suggests that Europe, the UK, but the EU in particular, are not feeling particularly warm to Elon Musk because we know that the European Union has been threatened by Donald Trump with tariffs. We also know that Elon Musk has been incredibly vocal on his X platform. He has criticised Keir Starmer, the UK Prime Minister. He's also the supporter of the far-right activist Stephen Yaxley-Lennon, also known as Tommy Robinson. So he is a bit of a Marmite character. And when you are trying to persuade people to spend a lot of money on a brand that they have to drive around in, then if they are not feeling very warm to the man behind that brand, potentially they could decide to look elsewhere. And that is certainly something which does seem to have happened in the EU in January.
It's the difficulty, I think, of having that real big personality figurehead chief executive. It really counts in your favor if everyone's loving him and loving what they're doing. But obviously, it can really turn against the company if sentiment towards that person really turns, or if they hit some sort of, scandal or bad news.
And of course, investor sentiment as well, Laura, was that because Donald Trump and Elon Musk are so closely aligned, that it would be brilliant for Tesla and any of Elon Musk's companies. But Donald Trump is not exactly a fan of electric vehicles. So it always felt like there might be some kind of friction there.
I think there's also legitimately a concern from shareholders when we look purely at the share price of, okay, well, Musk is all over the White House. He's all over things that are happening in the US government. How much is he keeping an eye on his other companies and how much is he actively involved in those companies? Now, I know previously he's spoken about the fact that he essentially doesn't sleep and has lots more waking hours in the day than probably you and I. But even so, I think as a shareholder, if you see that the chief executive of a company has become distracted, that probably is going to be a legitimate concern about the company's future, isn't it?
Yeah, I think you're absolutely right. I mean, we had that when he bought X, where a lot of people were saying, come on, what about Tesla? Are you just going to be focused on your new toy? But, he has a lot of fingers and a lot of pies, and a lot of those are very successful. But yeah, as a shareholder, you kind of want him to be laser focused on making sure that your investment is getting a good return.
We're going to talk about household energy shortly, but first let's talk about BP and its big shift away from green investing. What's going on here? This feels like the opposite direction to lots of companies going at the moment.
It absolutely does. And I have to quote Dan Coatsworth here because he was talking about this earlier. And he says that BP is the green terminator. Oil be back. That wasn't my particularly good Arnie impression. I promised him I would do the accent, but Look, this has been well trailed. we knew that BP was going to do something. Its last lot of results were not great, to say the very least. It's been under pressure, particularly from activist investor Elliott Management, to do something. And behind the scenes, there was a lot of talk that Elliott Management wanted to get rid entirely of BP's renewable arm, so put it up for sale and just focus on oil and gas. What we had today, finally, from the CEO, Murray Auchincloss, was a reset. That is what he called it. So instead of ditching entirely, putting up for sale the green bit of BP, they've scaled back the amount of money that they are going to invest in green technology considerably. I mean, we are talking about going from 4 billion a year to around 1 billion a year. So that is a significant scaling back. Instead, they're going to put their focus back on where BP started, which is in oil and gas. A lot more money is going to be spent on extraction. It's going to be up to 8 billion a year. They've said that they are going to have a whole load of new oil and gas projects. A lot will start by 2027 and then 8 to 10 more by 2030. Now, when you have the International Energy Agency saying that no more new fossil fuel projects are compatible with the globally accepted limit in terms of temperature, which, by the way, we actually breached between June 23 and March 2024, then it creates a lot of questions. But BP has been under huge pressure by lots of shareholders, because when you take a look at the share price performance and the profits which have been delivered by BP, and you compare it with competitors like Shell, it has fallen behind. And although I was looking back, and can you remember life before that first lockdown in 2020?
Barely, yes, but I can.
It feels like such a long time ago. Well, it was back then, it was back in February 2020 when the former CEO, Bernard Looney, stood up and said he was committing to making BP a net zero company by 2050. Now, if you think about what has happened between 2020 and now, and I'm particularly thinking about the cost of living crisis, the energy crisis, the invasion of Ukraine, which then created a lot of questions about energy supply security and made us all suddenly faced with really high, exorbitantly high energy prices, you sort of then begin to understand that the world has shifted on BP from where it was to where it is now. Regulations are changing. In fact, just this week, we've heard from the EU that they are looking to implement changes to key sustainability reporting requirements. So things have changes, not just in the investment landscape, but also in the political landscape, the regulatory landscape. So this is why BP has been under pressure to make these changes in the same way that lots of other big oil and gas giants have done. But there are still big questions, not least climate activists are incredibly unhappy, but also some shareholders are not happy at this change in direction. In fact, there were a number of shareholders who actually pushed to have a vote on this. 48 called for the company to allow them to vote on the change in direction because they're concerned about the future of the company. So they're not just thinking about returns on their investment over the next 5 to 10 years, but they're thinking about returns on their investments in 10, 20, 30 years' time. And even though we're hearing a lot from Donald Trump, drill, baby, drill, we're also seeing other companies continue to make those investments in clean, green technology. And certainly the UK government is really pushing to get more of that clean, green technology here in the UK.
And finally, for market news this week, we had the news that Unilever's CEO is stepping down after less than 2 years in the role. So what does that mean for the business?
Well, it was a surprise. It was quite a shock when the news dropped just a couple of days ago. I think it caught all of us on the hop because um, Heinz Schumacher's only been in the job for less than 2 years. And he had been incredibly outspoken about his turnaround plans, about cutting the number of products that Unilever has on the shelves. He has spearheaded plans to take the ice cream division separate, to float it on the Amsterdam, London, and New York stock exchanges. Amsterdam will be the headquarters. And he's been really sort of laser focused on cutting costs as well. So I think everybody was surprised by the news that he's going pretty much immediately. And that, of course, suggests that all has not been well behind the scenes. And we were just talking about BP and activist investor Elliott Management. Well, there's been an activist investor rattling sabers behind the scenes at Unilever as well, this time Nelson Peltz, and he's got a seat on the board. And we understand from reports that the entire board was unanimous when it decided to let Heinz Schumacher go and instead replace him with the chief financial officer, who will now take over running the company to continue with this cost cutting, to continue with this simplification, and most importantly, to deliver results. Because what investors have felt is that this transformation hasn't come as fast as investors would like. And it's fascinating when you look at the landscape of food and drink manufacturers and you compare the fortunes of Unilever with the fortunes of Nestle. Nestle also ousted their CEO last year ahead of this massive turnaround, which is finally beginning to bear fruit. And a lot of people perhaps thinking that they need a certain type of person in the job to really deliver on the numbers. And it's going to be fascinating to see what happens with Unilever going forward, how quickly it can deliver the kind of results which clearly investors like Nelson Peltz are expecting. But it did rattle a number of people who were caught on the hop, to say the least.
And you talked there about them spinning off the ice cream division. Do you think that there's an opportunity that we could maybe buy that and then we would have unlimited ice cream? Do you think that's a great investment move?
I think that would be a great investment move. Although I have to say that the one thing about Unilever, which I was not happy with, was shrinkflation. Because the Magnum
Yeah.
bars, I mean, they are small now.
We could fix all this if we bought that division.
I'm not sure it would do much for the bottom line. But let's delve into personal finances now, since we're talking ice cream and how far our money will stretch. And I was talking about this earlier, energy prices, and this week saw the announcement of the latest rise in Ofgem's energy price cap, which has had a big impact on household bills. Laura, tell us more.
Yeah, so this is the announcement of the next tranche of the energy price cap, which comes from Ofgem. And this will apply from the period of April the 1st till June the 30th. So we now get these energy price cap updates quarterly, and that sets that standard variable rate, the energy price cap for those 3 months. So it's rising. I think that probably won't be a surprise to lots of people, but it is disappointing news. So it's increasing by 6.4%. And so for the average household bill, that's adding £111 onto the annual average bill. But of course, the cap is based on the unit of energy. So if your energy bills are higher, then you'll likely see a much higher increase in those bills. So things like if you have a bigger house, if it's draftier, if you've got lots of housemates, or like you, Danni, teenage daughters who probably take very long showers, your energy increase will be higher, your bills will be higher. Conversely, if you don't use much energy, if you've really cut back on the energy you use, or you live in a small house or live alone, then you will likely see a smaller increase in your bills than that £111 for the average. But it's yet another increase on our energy costs. energy prices now are far below their peak when we had that real period where the government had to step in and put a cap on the cap effectively. So we have seen energy prices drop from there, but what we're still seeing is that prices are around 50% higher than they were pre-COVID. So we're still seeing much higher energy bills than we were before. There's some bits of good news. I guess the first thing is that this kicks in April, and at that point people are less likely to have their heating on, they're less likely to have their lights on for longer because the mornings and evenings will be getting lighter. So it's a less energy intensive period generally for people. So at least this price rise is coming after the winter. But it is still very tricky for people affording those bills. And part of the main reason that those energy costs have risen is because wholesale gas prices have risen. We had a very cold winter across Europe. We also had not much wind, which sounds like a weird reason for why energy prices might have risen, but it means that we had reduced renewable energy production. And so all of that has led to reduced gas storage levels across Europe. And it's another sign of, our domestic energy market being very reliant on the wholesale gas market and prices there.
And one thing that people might be wondering is, look, how can we cut energy costs? Because I've heard a lot of talk about fixing.
Yeah, and I think that is the real key message here. So for a long period, we had the energy price cap in place. Then, as I mentioned, we had the government's cap on top of that cap. And essentially at that point in the market, there was no competition. Everyone was on the energy price cap. No energy companies were coming out with good fixed rate tariffs. And for a long period, there just weren't any other options. There were no fixed rate tariffs on offer. That has now changed. And so we all need to kind of get out of that mentality of just sitting on the standard variable rate and get back into the mentality of fixing an energy deal and switching around and being a bit more savvy shoppers in that market. So there are options out there now for fixed rate tariffs that are below the energy price cap rate that's going to come in from April. So definitely look at what your provider is offering you, look around at what other providers are offering you and what you could get if you switched. There's a few different things to bear in mind. One is that a few providers are offering a reduced standard variable rate. So that could be a really good option for someone who wants flexibility. They don't want to fix and lock in on a rate for a certain period of time, but it means that they'll be paying less than the energy price cap. Or the other option is to get a fixed rate tariff. Now, of course, your risk with getting a fixed rate tariff is if energy prices drop during that period, you're fixed at that higher rate. So it's a good idea to look at like 12-month fixes rather than very long-term ones, because we have a bit more oversight of what energy prices are going to do in that 12-month period, and they're not expected to move dramatically up or down. The other thing to look at is exit fees. So make sure that the deal that you're fixing doesn't have a huge exit fee. And then that way you can get out of the deal if you want to. But it's a real kind of mentality switch, I think, now. We've seen around 4 million people switch onto fixed rate tariffs, but there's still around 29 million people on the standard variable rate. And so it's about those people shifting onto fixed rate deals. And that's the best way at the moment that you can cut your costs. There are other ways, of course, the classic using less energy. But I think when we're at this point of the cost of living crisis, lots of people have made those easier fixes and those energy reduction moves to try and cut their bills. So fixing is kind of the best option at the moment. I think the other thing to mention is that there's lots of households who are in debt to their energy companies. So overall debt to energy companies is £3.8 billion now. And on average, for someone with an electricity tariff, it's £1,500 that they owe per customer. And for gas, it's £1,300. So it's very significant debt that people have built up. And a lot of that is low-income households who've built up this debt throughout that real energy crisis. Ofgem, the regulator, is looking at doing something for those people and trying to introduce some sort of debt alleviant measures. The government has extended its warm home discount scheme. So this is £150 off bills. It's extending it to more households. But I think the other key message is if you're struggling to pay your bill, then get in touch with your supplier or contact someone like Citizens Advice, and they will be able to give you a bit more information on the kind of help and grants that you could access.
And sticking with personal finances, because you've also been shedding some light on the sneaky cash savings traps that could see you paying more tax than necessary. This is what I want to hear.
Yes, definitely. So this is a good way of saving you money on your tax bill, which everyone wants, surely. We've done some digging, and we found out that this year, just over 2 million people are going to be paying tax on their cash savings in the current tax year. And that's because lots of people haven't used ISAs, and therefore the interest that they're getting on their cash is taxable. And at the same time, lots of people are breaching what's called the personal savings allowance. So this is the amount of money that you can earn tax-free from savings interest every year. It's £1,000 for basic rate taxpayers. It's £500 for higher rate taxpayers. And if you're an additional rate taxpayer, then you don't get any of this allowance. What we've seen in recent years is obviously interest rates have gone up, and that means that we're all earning a decent amount on our cash savings. So more of us are hitting those limits, that personal savings allowance limit. But equally, more people have moved into the next tax bracket, so gone from being a basic rate taxpayer to a higher rate taxpayer, or if they're fortunate, from a higher rate taxpayer into being an additional rate taxpayer. And that means that they've seen that tax-free allowance really chopped down. So for the current tax year, if you're in that position, it's kind of a little too late to make a difference now, because we're in the final months of the tax year. But you can use these final months of the tax year, and crucially your ISA allowances, to help mitigate the tax bill for the next tax year. And so there's a few things to bear in mind where people might be caught out by this tax on their savings. The first is fixed rate accounts. So lots of people have locked into fixed rate accounts to get higher and guaranteed returns on their cash savings. We saw loads of competition in this market, and lots of people signed up to fixed rate accounts. But there is a tax risk with this. So the interest that you get from these accounts is taxed when it becomes accessible, which is a lovely bit of kind of tax jargon. But what it means is, if you get all of the interest paid out at the end of the period of your fixed rate account, that is when all of that interest will become taxable. So it's more of an issue if you've opted for a longer term fixed rate account. So say you went for a 3-year fix or a 5-year fix, and all of that interest is being rolled up until the end of that fixed period and when the account matures. If all of that is paid out in one tax year, that on its own could tip you over your personal savings allowance and mean that you're then going to pay tax on the other savings interest that you make. So that is a key one to look out for. To avoid it, you can either use an ISA version of these fixed rate accounts, or you can get an account which pays out the interest each year, and in which case that would be taxed in the separate increments. I'll pull out one more, which is children's accounts. There's a really tricky thing here that I think lots of parents aren't aware of, which is if your child earns more than £100 in interest on money that you've gifted them, then it's taxed as though it's your own. And this is a way to avoid parents just funneling money into an account in their child's name to avoid having to pay tax on that interest. But it means that there's lots of children's accounts that are paying 5%. So that means if you gave your child £2,000 in savings, you could end up hitting this threshold. And then all of that money, not just the amount over £100, all of it is taxed as though it's your own interest. And so that could then land you with a tax bill if you've got your own interest on your cash savings. You can sidestep this a few ways: split contributions between each of the parents, and then if you're splitting them equally, that's splitting the burden there. You can use a junior ISA because they are, of course, tax-free and you don't pay any tax on that money. If one parent has some of their personal savings allowance left and can afford to take that hit, then do it. Also, it doesn't count for money that's been gifted by grandparents or aunts or uncles or friends. So maybe just go round with your begging bowl and get some money from family and friends for your kids instead of paying the money in yourself.
Those are some really good tips, Laura. Thank you very much indeed. And if you're wondering why we're not talking about NVIDIA on this pod, well, it is because we're recording this at lunchtime on Wednesday. We have the results from NVIDIA later today, and we will take a look at that in next week's podcast.
So next up, we have got some investment ideas for those of you looking for ideas for your portfolios. Finding a fund that delivers a steady stream of income alongside impressive total returns feels a bit like finding the holy grail in the investment world. But fortunately, Tom Sieber, editor of Shares magazine, has been digging into the investment trust sector to find just that. So these trusts are called dividend hero trusts. First up, Tom, can you just explain what that term means and how many trusts sit in that particular camp?
Yeah, of course. Thanks for having me on the pod, Laura. So yeah, the dividend heroes is a term that was dreamt up by the Association of Investment Companies. So that's the industry body for investment trusts. And the list includes those investment trusts which have increased their dividends for at least 20 consecutive years. And there's around 20-ish names on that list. And when you consider there are upwards of 300 UK investment trusts, it does represent a pretty select club. There is also a list of 31 so-called next generation dividend heroes, which have increased their dividends for a decade or more, but less than 20 years. And when it comes to this list, some names will be familiar to people who have maybe at least a passing knowledge of the investment trust space. So you've got the likes of Allianz, Witan, F&C, Scottish Mortgage, and then there's some other names on the list that are a little bit more obscure than that.
Okay, and so then you took a look at that list and looked at the ones that hadn't sacrificed overall returns in order to deliver that income. And what did you find out?
Exactly, yeah. So what we wanted to discover by looking at a little bit more detail at this list was those trusts which have performed best in terms of their total return. So I'm sure most people are familiar with the term, but essentially the dividends and the capital gains put together over that kind of 20-year period that is the kind of cutoff for making it into the list of dividend heroes. And having crunched that data, we feature in this week's Shares magazine the top three. So that is Scottish Mortgage, F&C, and a slightly less known name. I mentioned there were some sort of more obscure names in that list of heroes in BlackRock's smaller companies. We've also looked at the best performing names over 3 and 10 years. And what's quite interesting is we've managed to get some information on how much of the total return has been generated by dividends and how much has come from capital gains. And there's quite a big divergence, even though all of these companies are sort of known as dividend heroes and they've all got, quite a proud record of increasing the dividend. Some of them, a lot of the gains have come from capital gains. And then for others, the reverse is true. A large proportion has come from the income.
And what about some of the things that investors need to look out for with these trusts?
Yeah, thanks, Danny. So I think it's worth saying that even though, all of these names have got a very consistent dividend track record, dividends aren't guaranteed. What investment trusts have in their favour in this sense, though, is that they're able to hold back some of the income they get from their investments to provide a bit of a buffer so that if they have a lean year in terms of income from the portfolio of holdings that they have, it doesn't necessarily preclude them from paying out a dividend. The other thing to say, and one of the reasons we really wanted to look at this in sort of terms of the context of the total return these trusts were delivering, is that I think trusts have got wise to the value of being a dividend hero. It's quite a sort of, it's a marketing tool, if you like, that they can say we're a dividend hero trust. And some names, it's still an impressive feat to have increased the dividend so regularly, but some of the increases might be quite piecemeal. They're quite small. So I think that's why, it makes so much sense to look at the total return as we've done and kind of get a sense of, are they really delivering, or are they kind of, paying lip service to the term maybe, or certainly not delivering perhaps the most impressive returns, particularly if you compare it perhaps with inflation. For example, if the increases in the dividend are pretty modest, then essentially they could be wiped out or raised by inflation.
Thank you so much, Tom. And don't forget, you can catch up on all sorts of market news and investment news in Shares magazine. Now, it is not often that the FTSE All-Share Index of UK shares outperforms the US market, but that is precisely what's happened so far this year. We dispatched Dan Coatsworth to talk with Abbie Glennie, manager of the Aberdeen UK Smaller Companies Growth Trust, about what is going on with UK stocks outside of the top-tier FTSE 100 index, and this is what she had to say.
So, Abbie, given the prospect for weak economic growth in the UK, potential for rising inflation, it does look like interest rates might stay higher for longer. I mean, against that sort of backdrop, which type of company is likely to do best in that sort of environment?
So I think there's definitely a lot of caution about markets at the moment, but that's not just in the UK. We're seeing that in many major geographies around the world. I think in the UK, we have obviously seen, the biggest disappointment for me has been the growth expectations coming down, particularly on the back of, a budget which hoped to stimulate that. The inflationary pressures I perhaps feel less concerned about than others. So I think there's still room for us to continue to cut rates despite that sort of recent higher inflation print. And I do think that in a way, the fact that growth has been disappointing perhaps leads them to have to stimulate growth more. At the moment, though, we are feeling reasonably cautious about the outlook. I would say that, areas that if we had sat and talked about a year ago that people had hoped might be recovering sectors, we still haven't seen that in a lot of those. And actually, where we're standing today, I still don't think if I do the outlook for this year, that those look particularly healthy or improving. So one of the main things that we focused on at the moment would be around that resilience, that quality of earnings, companies with long, sticky revenue streams, good customer relationships, pricing power. And I think one of the things that we are seeing as well is that, expectations are still in some ways quite negative in the UK, but also valuations are quite negative. So I think we are coming from a good starting point in that regard.
So, I mean, I think when people think of sort of sticky revenues, reliant earnings, I think people just go, okay, what do you mean, like a tobacco manufacturer or utility company? But there's more sectors, aren't there, than that? Which sectors would you sort of take your eye in that sort of situation?
So I think we've got sectors and we've got companies. So actually, one of the sectors that we own a few companies within would be food producers. And actually, you talk about tobacco, in UK small cap, it's really quite diverse. So a lot of those more traditional defensive sectors you get in large cap actually don't necessarily exist in small cap. So a lot of our sort of more high earnings quality visibility companies. So for instance, in food producing, we have Cranswick, we've got Hewson, we've got Premier Foods. We've got things like XPS Pensions and JTC. So one's a pensions administrator consultant, sort of advice company, and JTC is a fund administration business. We've got other things like Me Group, for instance, which does photo booths and also does communal laundry facilities, and it's got its own rollout process going on in that, which drives growth. And I think those sort of things, they're not tech companies where they've got contracted revenue in the same way. They do have dependency on other things like pricing or volume. So there's some sectors that you can really get that sort of visible software as a service contracted revenue. And the fund administration type stuff is a bit more like that. And then others like those food producers, which I think have just proved themselves over time at sort of being quality defensive plays.
Okay, I mean, I get the impression that we're sort of seeing a slight shift in the market. I mean, some of this in America, some of the big tech stocks aren't really performing as well as they have been. Actually, if you look at the UK stock market this year, it's not bad actually, the performance. So do you think there's a sort of a rotation underway? Perhaps investors looking for sort of the cheaper stocks, ones with defensive qualities, because there's plenty of them on the UK stock market.
Yeah, so I think, and I would say actually a lot of UK returns last year were pretty healthy as well. But the problem is when you've had this sort of Mag 7 driving US returns to be pretty astronomical, everything else has looked, dull in comparison. But in any other environment, I think people would have been very pleased with the sort of returns they were getting, for instance, out of the UK small cap space. If you can get a high single digit type return sustainably, I think that's pretty good for this sort of asset class. But I think definitely we are starting to feel that rotation in markets, and I would say that that's only really been felt in the last couple of months, so the sort of start of 2025. I think if you look at asset allocations, they're so heavily overweight US big tech, Mag 7, whether that's been a deliberate choice from people or a mix of everything. Because a lot of people, if they think they have global equity exposure, when they actually look at what that constitutes now, it's heavily US sort of Mag 7 focused. And you look at I think the market cap of those companies now is something like $18 trillion. So when we start to see that shift in reallocation into other asset classes, even a small shift can be really very meaningful. I think there's a couple of things that have driven that. I think it's been building up over time. We obviously had the DeepSeek news flow, but I think also just if you look at the earnings growth out of those Mag 7 and how much faster earnings they are growing than even actually if you just look at within the rest of the US, that's really compressed. So, they're not outgrowing the other companies the way they were. They're not really beating expectations to the same degree as they were as well. And now their ratings are on such high premiums that I think people are really starting to look at least diversifying. So whether people still have some exposure to that, we're seeing from clients that they're looking to offset some of those risks by diversifying into other areas of equities.
Yeah, I mean, I know we're only a couple of months into the year, and perhaps when you look at you judge an investment, you look much longer term. But what's actually been doing really well in your portfolio this year? And is there sort of an obvious reason? Is it down to sort of good news flow or just general sentiment?
Well, I think this year, I would say generally good news flow. So companies who have been beating expectations, we have seen share prices perform well on the back of those. I think there's definitely still been a decent focus towards that earnings resilience, that quality. Whereas if we looked longer term, so if you look, for instance, over 2024, actually in UK small cap, value still did quite well as a style and a factor. Actually, that really started to tail off through the year. So it was, value really outperformed growth near the start of 2024. By the time we got to the end of the year, that theme had really passed. So we aren't really seeing that sort of cheapness be the thing that matters so far this year. Actually, if I look at our best sort of companies over the last 6 months in terms of across the portfolio, it has been quite a mix. So things that have done well have been, I've mentioned XPS Pensions before. So they've had earnings upgrades. They also did a deal today as well, an acquisition, which we've been pleased to see, about a business called Polaris. We've seen things like Cairn Homes, for example, still do very well. So Cairn Homes is an Irish house builder, predominantly around the Greater Dublin area. And we talk about those areas in the UK that maybe aren't recovering yet. I would say that Cairn Homes has been sort of exhibiting all the characteristics that every UK house builder wishes that they had, but they just don't have yet. So those things all really continue. So, they've got really good supply, good affordability, a government who are really supportive of the industry, but importantly have the cash to do that. Not even forward funding schemes. And they've got this sort of planning approval process and the contractor and supplier base as well to actually drive out volume. So that's continued to be really good. We've seen Morgan Sindall would be one I would say has been a standout in the UK. So it sits within the sort of construction contractor sector. But it really has been a standout in terms of the strength of that business, in particular their fit out business, which a lot of that is sort of heavily office focused. And they have continued to take market share there. And this is just an incredibly well managed business with real culture and longevity of service within it. And actually, they've seen their biggest competitor in that fit out business, ISG, go bust. So we think they continue to have market share opportunities. Other things which have done well, a couple of more stock specific ones, I would say. So Raspberry Pi, which was an IPO from last year, a really unique tech asset in the UK, had a really strong finish into the year. And actually, we think a lot of that was around short closing. So that's sort of quite a unique situation for that one. The other one which has done really well that we own is Trustpilot, which has been listed for a number of years in the UK, was very much out of favour for a while in terms of when the stock market turned against looking at investing in growth businesses. But I think that business under sort of newer chair and CEO has really turned around operationally. So we're seeing them really be disciplined about their investment. They have a real flywheel of growth in the UK, which drives good cash generation, and investing that as well in the US and expanding there. So actually a real mix of business crystal across different sectors. And I think that's important. That's what you get in UK small cap. You don't often get, one sector or one really strong theme. I think actually company specifics probably matter more when we look at those dynamics.
I mean, I think last year there was quite a lot of excitement when we had a change of government. Everyone's going, okay, like, perhaps there's more clarity from a political point of view. Therefore, people might start to be much more interested in UK stocks. And naturally, they might look at the smaller cap space. But it sort of feels like sentiments change. People going, actually, look, Rachel Reeves said she had a plan to drive the economy. Now it's going to clearly take a lot longer than previously thought. Sentiment seems to be quite negative. And so is that weighing on quite a lot of the small cap space, or perhaps investor risk appetite to want to own the smaller companies?
Yeah, I think it's an interesting one because obviously we had this growth agenda. We had policies which they thought would drive growth, which many people were skeptical about, and so far rightly so. And we've definitely seen that cause challenges for businesses. So key would be higher cost base, in particular in terms of what we saw with the national insurance contributions. And we've definitely seen companies be more cautious about headcount since then, more cautious about investment. And none of those things are what the government wants to see to drive economic growth. Where you drive economic growth in the UK is through UK small and mid caps. The mega cap space as such doesn't really drive the same level of domestic economic growth. It's obviously much more internationally exposed, but also, a lot of the benefits and growth tend to flow internationally. I think what you get in UK small and mid cap is a good mix. So you absolutely can drive UK economic growth through that, but you also have 50% of your revenues generated overseas. So, for investors, I think that gives them really good actual diversification, even within UK small cap. So I think that we will see, more of a drive towards trying to drive the economy, whether it be through regulation or investment. What we're seeing from investors at the moment is definitely, I would say still some caution towards UK small cap, but definitely more interest. We've already seen, I would say, in smaller companies, interest pick up, particularly across, for instance, Europe. And for whatever reasons, we do see that European investors seem more willing to back their sort of domestic smaller companies. I think as much as the outcome from the government maybe hasn't been what people hoped for so far, at least we are past those biggest political risks. And we're sitting here today, we've had the German elections over the weekend. There are other areas which have far more political uncertainty than us. But I think one thing we might see in the UK is actually that we see the UK overall become more attractive to investors for many reasons. And actually, you might see that sort of in large cap flowing down into small cap.
Yeah, I guess, do you think we really need lots of overseas investors? They're the ones that will really drive, if they returned, they showed much more interest. Is that the key driver here that we really need for small caps? Or do you think actually we could get it just from domestically?
I think we absolutely could get it from domestically if people wanted to, make those allocations. And it is one area that I sort of still hold out hope that we have government regulation towards. So, for me, the biggest pot of capital that is not being used towards sort of UK economic growth through allocations to UK small cap, for instance, is the pensions. If we look at that, it's very sizable and it could really make a difference. I think, we also aren't seeing the retail participations that we have in previous periods. So I don't think we need, international to be the big driver. One thing we should remember, though, about UK is that like if I think about UK small cap, it does benefit from allocations to European small cap, to international small cap. So you're typically European small cap. So if you look at the MSCI, it's about 30% of that will be UK constituents. If you look at international small cap, so like an ex-US product, that's about 13% will be UK small cap. So you get broader benefits there, and obviously from global small cap funds as well to a degree. I think another place that we are perhaps seeing international interest would be in the investment trust space. So for those who particularly are willing to take a sort of longer term view, you're getting double-digit discounts on the investment trust space at the moment, and most of these trusts, including ours, have gearing. So there is an additional return dynamic possibility there.
Well, brilliant. Well, Abbie, thank you ever so much for coming on the podcast. It's been brilliant to talk to you.
Thank you so much, Dan.
That was Dan Coatsworth with Abbie Glennie, manager of the Aberdeen UK Smaller Companies Growth Trust. And that is also everything for today. So thank you very much for joining us, and make sure that you subscribe and leave a review wherever you listen to your podcast, as it helps other people to find us. And we will see you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.